I learned early in my career that the market punishes impatience with far more precision than any operator ever could. I recall a campaign in Union Pacific where I allowed excitement to outrun judgment. Price was advancing briskly. The public was scrambling over one another to get aboard, and I, fearing I'd miss the move, bought several points above the level where the composite operator had been quietly absorbing for weeks. Within days, the stock sagged back into its old range, leaving me trapped in a poor position and forced to watch price drift slowly, almost mockingly, toward the level where I should have waited in the first place. That lesson has followed me ever since in every campaign worth trading. The best entries come to the patient trader who understands the rhythm of supply and demand, while the man who chases price inherits nothing but stress, bad fills, and the constant burden of hoping the market will forgive a reckless decision. Chasing price is the fastest way for a trader to lose sight of the only thing that truly matters, the ongoing dialogue between supply and demand. When a market begins to move, especially with speed or emotion, the inexperienced trader feels an instinctive pull to act, an urgency born not from logic but from fear of being left behind. The tape seems to accelerate, the bars stretch wider, and every uptick whispers that a great opportunity is slipping through one's fingers. But this sensation is a manufactured illusion, created not by the underlying structure of the market, but by the trader's own psychology. The moment a trader allows that internal pressure to dictate decisions, the reading of the market becomes distorted. Instead of observing the behavior of volume, spread, and effort versus result, attention narrows to a single point: I must enter now. And that singular focus blinds the trader to the larger, more informative narrative unfolding beneath the surface. The professional's eye is always stationed at the level where the next important test of supply or demand is likely to occur. Markets do not move in straight lines. They pause, correct, test, and retest. Each of those pauses is an opportunity to evaluate the underlying conditions, whether demand is proving itself or whether supply is beginning to creep in. When a trader chases a breakout already in motion, the context of those prior phases becomes irrelevant in their mind. They forget to ask whether the breakout is being supported by legitimate buying or simply driven by short covering and public enthusiasm. They overlook whether the move is occurring near resistance or directly into overhead supply. And so, blinded by the speed of the moment, they enter at precisely the point where the risk is greatest and the reward is thinnest. In every accumulation or distribution, there are key areas where professionals buy or sell with purpose. In these zones, volume behaves in a very specific manner, and price action reveals whether large interests are absorbing or unloading. But these areas rarely coincide with the dramatic moments that attract the attention of the crowd. By the time the public begins to chase a move, the smart money has already positioned itself quietly, long before the headlines or emotional surges. The trader who chases price trades against these informed interests without even realizing it. They buy when professionals are selling into strength, and they sell when professionals are absorbing weakness. This behavior is not the result of poor market knowledge, but of clouded perception. Perception blurred by the rush to catch up. To see the market clearly, a trader must detach themselves from the illusion of urgency. The tape never forces anyone to act, it simply records behavior. The trader who disciplines themselves to observe rather than react preserves their ability to interpret the language of price and volume objectively. When you stop chasing, you start reading. You begin to notice the subtle shifts in character, the hesitations before a breakout, the absorption at support, or the sudden expansion of volume as supply emerges. These observations create clarity, and clarity creates opportunity. The trader who waits for price to return to structure is not being slow, they are being informed. And the informed trader always sees more than the one who is sprinting after a runaway market. The most reliable trades are almost always born at the edges of the auction, not in the center where emotion runs hottest. Every market cycle consists of areas where price is accepted and areas where it is rejected, forming a natural auction between buyers and sellers. Professionals wait patiently for price to return to these edges, places where demand has previously stepped in, where supply has proven dominant, or where a prior struggle left clear footprints of accumulation or distribution. These are the zones where informed interests make decisions because they offer structure, clarity, and logical parameters for risk. The crowd, however, rarely waits for such conditions. They prefer to act in the middle of movement, right when the market is already stretching away from value and into an emotional markup or markdown. This is where the inexperienced trader feels compelled to jump in, believing motion equals opportunity. In truth, motion is simply the aftermath of decisions made earlier at those edges. When price is already moving strongly, the trader who enters is stepping into the market's emotional center, where spreads widen, volatility increases, and the balance of effort versus reward becomes distorted. The move appears powerful, but the trader is buying at a level where the market is no longer offering structure, only speed. Without a nearby area of support or a logical reference point, the position becomes unstable. Stops need to be wide, targets become uncertain, and emotional stress replaces strategic thinking. The trader ends up managing chaos rather than participating in a calculated opportunity. Every tick against them feels threatening because there is no framework to judge whether the reaction is normal or the beginning of a reversal. This lack of structure is the natural consequence of entering far from the auction's edges. At the edges, however, the market behaves differently. Price often slows, narrows, and reveals intent. You see tests, springs, upthrusts, absorption, and rejection, all behaviors that communicate the presence or absence of real supply or demand. These moments provide the trader with information. Is the market ready to transition from one phase to the next? Is the dominant force weakening? Is the level being defended? This information is invaluable because it allows the trader to enter with logic instead of excitement. A trade taken at these edges has clear invalidation points, natural stop placement, and an understanding of how the move should unfold if the interpretation is correct. Risk becomes defined, the reward unfolds naturally. Furthermore, the edges of the auction are where the composite operator builds and exits positions. These interests never chase price. They accumulate during dullness, when the public is bored, and they distribute during strength, when the public is euphoric. If a trader wants to operate alongside the informed interests rather than against them, they must learn to think in terms of value, structure, and preparation. Waiting for price to come back to these critical zones is not a delay, it is strategy. It allows the trader to operate with calm, clarity, and leverage. Entering at the middle of emotion is like stepping onto a river rapid. Entering at the edges is like placing a foot on solid ground. The market always reveals its intentions at the periphery, not at the peak of noise, and the trader who respects this truth naturally aligns with the forces that control the larger movement. Emotional urgency is one of the most dangerous signals a trader can experience, not because the market is truly offering an opportunity, but because it reveals a weakness in positioning and perspective. When a trader feels that inner pressure to get in before it's gone, that sensation is rarely born from a logical assessment of supply and demand. It is almost always the echo of poor preparation, an admission that one did not anticipate the move, did not mark the critical levels, and did not build a clear plan long before price began to accelerate. Professionals understand that markets reward readiness, not reaction. When you are positioned correctly, mentally and structurally, there is no urgency. You know where price is likely to test, where demand should appear, where supply historically enters, and what behavior will confirm your read. Urgency only exists in the mind of the trader who has allowed the market to dictate tempo instead of setting their own. This urgency becomes especially dangerous because it disguises itself as opportunity. A sudden breakout, a strong bar, a rush of volume. These tempt impatient traders into believing they must act immediately or risk missing a windfall. But the very moment the trader feels compelled to chase, they abandon the foundational elements of sound market analysis. They stop considering whether the breakout is genuine or simply a trap designed to draw them in. They forget to question whether the move is supported by strong hands or whether it is merely a brief burst of enthusiasm from weaker participants. They ignore whether the market is approaching overhead resistance or whether volume is confirming or contradicting the movement. And with those blind spots, urgency becomes a trap, one that professionals rely on because it allows them to hand off positions at premium prices to those who can least afford to buy them. Poor market positioning creates this emotional vulnerability. When a trader does not have predefined zones of interest, they begin to rely on the momentum of the moment to tell them when to act. They convince themselves that the market is smarter than their plan, that they must bend to its speed, that hesitation means loss. But in reality, the loss comes from abandoning structure. The trader who waits for price to return to an area of value never feels this emotional squeeze. They know their opportunity lies ahead, not in the middle of a runaway bar. They understand that the most attractive trades are built on calm observation and anticipation, not on a frantic scramble for entry. Moreover, this emotional urgency often leads to a chain reaction of errors. A rushed entry tends to produce a poor fill. A poor fill results in a wider stop. A wider stop increases stress. Stress leads to hyper-monitoring. Hyper-monitoring leads to premature exit. And a premature exit reinforces the belief that entries must be fast. A single impulsive act spirals into a psychological loop that traps traders in a cycle of chasing, fear, and regret. Meanwhile, the professional sits quietly at the levels they have already mapped, unconcerned about missing anything. They know that true opportunity is not fleeting, it is structured, repeatable, and visible to the trained eye. When a trader eliminates this sense of urgency by grounding their decisions in preparation, the entire emotional landscape shifts. They move from reaction to anticipation, from stress to clarity, from scrambling to guiding. Emotional urgency fades the moment one gains control of timing, and timing is gained only by letting price come to predetermined areas of interest. In the markets, calm is a position and urgency is a warning. The trader who learns to detect and resist that internal pressure naturally moves closer to the mindset of those who consistently succeed. Patience is often spoken of as a virtue, but in trading it is an essential tool for creating asymmetry, where risk is minimized, logic is strengthened, and the understanding of market structure becomes sharper. When a trader waits for price to return to predetermined levels rather than chasing movement, the entire framework of the trade becomes more balanced. The entry is clearer, the stop is smaller, the target is more realistic, and the reasoning behind the trade is grounded in observable market behavior rather than emotion. This asymmetry is not accidental, it is the reward for disciplined preparation and the refusal to be pulled into the noise of the middle of a swing. A patient trader buys where demand has proven itself, sells where supply has shown its hand, and allows the market to come to them rather than attempting to force participation at unfavorable levels. The asymmetry is created not by predicting the market, but by selecting the right moment to engage with it. A patient entry naturally produces tighter risk. When price returns to a significant support level, the trader can place a stop just below the area where their thesis would be invalidated. They are no longer guessing where the market might turn. They are waiting to see it with their own eyes. This transforms the trade from a leap into the unknown into a calculated decision. The reward side of the equation becomes clearer as well. When a position is open near the structural origin of a move, even a modest continuation can produce a high reward. 2. Risk ratio. A trader who enters at value often captures the heart of the move, while the one who chases gets only the remnants. The gap between these two behaviors is the difference between consistent growth and constant frustration. Patience also forces a deeper understanding of market behavior. When a trader waits for price to come to their chosen level, they begin to observe the subtleties of how price behaves around that zone: volume contraction, absorption, tests, and confirmation. They learn to distinguish real strength from temporary enthusiasm, genuine weakness from momentary dips. This observational skill sharpens the trader's reading of supply and demand, turning the market from a chaotic stream of bars into a structured sequence of events. Every moment becomes meaningful, every reaction a message, every hesitation a clue. Patience is the gateway to this clarity, because it removes the emotional urgency that clouds judgment and replaces it with calm, focused attention. When a trader consistently waits for high-quality opportunities, their overall logic improves as well. They stop taking trades simply because the market is moving. They stop entering out of boredom, fear, or excitement. Instead, they build a rule-based approach where trades are taken only when the market offers the right combination of structure, confirmation, and risk parameters. This disciplined method naturally leads to fewer trades but better ones. It also creates psychological stability. A patient trader does not feel the need to chase because they trust their process. They know that opportunities will recur. They know that the market cycles through phases and that each phase offers new setups for the observer who is prepared. All of this reinforces the ultimate truth: patience is not passive. It is active discipline. It is choosing not to act until the environment aligns with your criteria. It is refusing to hand your money to the market simply because the crowd is moving. It is understanding that the best trades are quiet, controlled, and logical, not frantic attempts to catch up. Patience brings the market into alignment with your plan, and from that alignment emerges the asymmetry that defines professional trading. The market has no obligation to reward those who rush, react, or leap into trades without preparation. It offers its greatest opportunities to the trader who arrives with a plan long before price begins to move. Preparation is the foundation upon which every successful campaign is built. A professional does not wait for the market to look exciting before becoming interested. The groundwork is done ahead of time, key levels are identified, previous battles between supply and demand are examined, structural phases are mapped, and possible scenarios are outlined. This preparation transforms the trader from a follower into a strategist, while the average participant scans for signals, noise, or indicators to trigger an impulsive entry. The prepared trader is simply watching to see whether the market aligns with the conditions they have already defined. If the behavior confirms the plan, they engage confidently. If it does not, they patiently stand aside. This discipline eliminates stress, confusion, and hesitation. The market rewards this kind of readiness because it aligns with the natural rhythm of accumulation, markup, distribution, and markdown. These phases repeat endlessly, but their timing is not always clear. The unprepared trader is always late, always surprised, always reacting to what has already happened. They enter at the worst time because they are evaluating the market in real time, under emotional pressure, without context. When a sudden breakout occurs, they chase. When a sharp decline begins, they panic. When a reversal forms, they misinterpret it. Their trading life becomes a series of reactions rather than decisions. In contrast, the prepared trader has already studied how the market arrived at its current level, where strong hands have likely acted, where weak hands are positioned, and which behaviors would validate or negate their analysis. This preparedness gives them the confidence to wait for price to return to a level of advantage rather than running after it blindly. Preparation also brings clarity, a clarity that replaces emotional impulses with logical steps. The prepared trader knows exactly what they want to see: a test of supply, confirmation of demand, absorption at support, rejection at resistance, or a shift in volatility that signals a turning point. They do not need to guess. They do not need to hope. Every action is based on observable behavior. This clarity allows them to recognize when the market is behaving normally and when it is exhibiting warning signs. Instead of being swept into the emotional tide of the crowd, they watch calmly, knowing that the market will eventually offer a well-structured opportunity. This calmness is itself an edge because it prevents the destructive behaviors that come from impatience. Moreover, preparation strengthens risk management. When one has already plotted the correct areas of interest, stops can be placed with precision, and position sizing can be determined before the trade begins. The trader knows exactly how much they are willing to lose and how much they stand to gain. This pre-calculated structure eliminates the need for impulsive decisions mid-trade, allowing the trader to operate with discipline instead of emotion. Without preparation, stops are guessed, targets are vague, and exits become panic-driven. This is why unprepared traders constantly feel stress. They enter without a framework and must make decisions under duress. Ultimately, the market rewards preparation because it aligns the trader with the flow of informed activity. Large operators plan far in advance. They do not chase price. They wait for their levels, they build positions quietly, and they execute with patience. The trader who prepares in the same way positions themselves to act with clarity and timing rather than fear and urgency. When you approach the market with a structured plan, each trade becomes a deliberate choice rather than a frantic gamble. The difference is profound. One leads to consistency, and the other leads to chaos. In the end, every part of this discipline circles back to one fundamental truth. The trader who lets the market come to them operates from strength, while the trader who chases price operates from weakness. Chasing blinds the mind, distorts perception, and places the trader directly in the path of emotional traps designed to exploit impatience. Waiting for the edges of the auction restores clarity and structure, revealing where true buying and selling actually take place. Emotional urgency fades when a trader is prepared, and preparation itself removes the need to rush, guess, or react. Patience then becomes the engine of asymmetry, allowing trades to be built on logic, evidence, and controlled risk rather than speed. Each principle feeds the next, forming a complete philosophy: observe deeply, prepare thoroughly, act only when the market aligns with your framework, and refuse to let fear or excitement dictate your timing. When these components work together, trading becomes calm, precise, and consistent, no longer a battle against the market, but a disciplined engagement with its rhythm.